So since the bottom of the pandemic a year and a half ago, we had maintained an above consensus growth outlook as the monetary and fiscal support were very large. And also we anticipated that vaccine efficacy were to be proven to be very effective. And that has been the case. But looking ahead, we still see continued economic expansion, but the growth momentum will likely decelerate. The fiscal support will slow inevitably as the size of the spending cannot be sustained. We've seen tremendous spending over the last 12 to 18 months. The US in particular will experience the strongest decline in fiscal support over the next 12 months. So offsetting these sort of headwinds, we do have a consumer that has accumulated excess savings and will likely at least put some of these excess savings back in the economy in the forms of services purchases, probably more than goods. Unemployment will continue to decline, as is the objective of the Federal Reserve in other countries, and therefore we'll continue to see growing disposable income. Finally, another offset to the headwinds will be rebuilding of inventories because inventories are at historical lows. So net, the impact should be positive growth over the next 12 months, but the pace of that growth will decelerate looking forward. So just how much economic deceleration will depend on a number of factors that we will be closely monitoring. Inflation is first in the mind of investors. There's a few sources of inflation. Commodity prices, particularly oil, are likely to remain elevated. This will likely sap consumer buying power as they pay higher prices and divert spending towards energy relative to other goods and services. But energy as a share of disposable income, it's important to remember it's lower today than it was 10, 15 years ago. It's about 3.5%, 4% of disposable income. It used to be in the early 80s, over 8%. It's not enough to completely derail the consumer because of higher prices. Other inflation aspects is computer chip supply shortages that we're seeing, bottlenecks in ports. That may keep goods prices elevated and force the hand of the Federal Reserve to hike and create a policy error. We think the Fed and other central banks will be patient as they are close to lower bound interest rates. And so we think this Federal Reserve will be patient, but it is a downside risk to our main scenario. Finally, the resolution in China's real estate deleveraging is an important factor. We think that the real estate sector will cause a drag in Chinese growth over the next 12 months, but a lot of it has already occurred, and we don't expect it will trigger a broader systemic risk, as the Chinese financial system is not as integrated with the global financial system as we saw, for example, in the US in 2008-9 during the global financial crisis. So these are the risks that will be offsetting, and the deceleration will depend on how these risks will play out over time. Investors should first realize that the growth versus inflation mix will be a little less supportive of financial markets as we saw over the last 12 months. And that's because growth is decelerating and inflation may be sticky a little bit longer until early 2022. In that environment, equities should outperform bonds as inflation is not very friendly to bonds relative to stocks. So we would stick to an overweight in equities, but we have to be prepared that the volatility environment will be a little higher than what we've just experienced in the last 12 months or so. High commodity prices are probably going to be with us a little longer. We would favor commodity producing countries and sectors relative to more defensive sectors, for example. In that case, Canada, both from an equity perspective and a Canadian dollar perspective, is interesting. Credit exposure should be a bit more neutral in that environment. We're starting with tight spreads. And if we think that interest rates are going to rise a little bit at the long end, that creates a limited upside from a credit perspective. We would look more specifically at emerging market debt in selected countries, they provide better value and they have steeper curves, which typically foretells better performance over time.